Welcome back to the IB Investor channel. In this video, we'll take a look at the most recent earnings report for Lagercrantz Group. Now, for this company, it's a little bit different because Lagercrantz Group has a broken fiscal year. So in the most recent quarter that we define as Q3 2023, Lagercrantz actually reports their second quarter for 2024. Now, this might be a little bit confusing, but the numbers are what they are and won't change because of this. In this video, we'll go through the cash flows, the debt situation, and the CEO remarks to see if there's anything interesting showing up. But at first, we'll check the stock price and its returns. And we can see here, and this is from my broker, Avanza, we can see here that the share price has done very well for itself for a long period of time. We can see there's been pretty much explosive growth here ever since 2019, 2020, and we'll see if the number supports this growth or not, but at least the share price has done very well. And we can see here the maximum return here for this period has been 2,800%, which excludes dividends here. Dividends are not included in this number. And we can also see here for the 1 year period, it's actually up 6%, more than 6%. For the 3 year period, it's up 70%. And for the 5 year period, it's up an impressive 250% almost. However, as of most recent time, the stock has traded down, and we can see here just for the trailing 3 months, the stock is actually down more than 22%. It's not one of the most commonly owned shares, but rather there's only like 6,600 shareholders at Avanza. So quite an unknown stock, I think, for many shareholders. Now looking at the net sales and the EPS situation for this company, and do mind that this is the trailing 12 months we're looking at right now. But before anything, we'll start with the gross margins here in the green one. So we can see here that the gross margins right now sits at 38.7%. And do remember that this is somewhat of an industrial company, so it's no surprise that the margins are lower that of compared to, for example, Evolution that sits at like 80%, which is a massive amount, but it's a software company, so it's a difference here, I would like to say. And we have to remember that when looking at those numbers here. Also comparing it to peers, we see Lifco 43.3%, so that's quite impressive for being an industrial company. And then we have Indutrade, which is probably more in line with this company, that sits at almost 35% gross margins. We can also see here that we have the profit margin here at 10% in the most recent quarter, which is okay for this type of company. And we can also see that the profit margin has been very stable here at roughly 10% for most quarters here going back a few years. Now looking at the net sales, which is the blue line here, and we can see that the blue bars here are going up all the time, which is what we like to see. And we can also see here that the earnings per share is trailing along as well. It's actually overtaking the net sale growth for some years here, but it looks pretty okay and pretty good, I would say. And compared to New Wave, the other company that I just made a video about, we can see here the difference is that the quarter over quarter they actually have growth, so it's not going up and down depending on what quarter it is. So this is one of those type of stocks that just gives a lot of stability for the investors and not a lot of upside and downside on the net sales and EPS from quarter to quarter. So what this just paints is a very stable picture for investors when they see a company with numbers such as this. Now for the free cash flow margin, and this is for the trailing 12 months, at least for this period here. So we can see that they posted a 9.8% free cash flow margin here in the most recent quarter, which is basically the Q3 quarter. So this is actually a pretty accurate number still that we're looking at right now. We can see in the other quarter here, they posted a 7.2% free cash margin. However, we've seen many years here, or many quarters, where the free cash flow margin has been negative. And this is oftentimes something that investors don't like to see, because obviously, or not obviously, but many investors like to see that the free cash flow margin is positive all the time. But this company, or management rather, has not been able to produce margins that have been positive over this period. And we can also compare it then to the latest quarter here, or most recent one, to Adtech, that has a 7.1%, and Indutrade, which comes in at a much lower 1.6% here, free cash flow margin. Now for the free cash flow per share. So we see here also trailing 12 months here. We see that in the most recent quarter they posted a 3.7 kroners per share in free cash flow. Not saying it's good or bad, because I think the history here is a little bit too short to make any assessments whether or not this number is sustainable or not, or if it's going to continue to grow, or if it's going to be negative in the next quarter. But this is the number at least, and we won't dwell on this anymore. Now for the cash flow overview for the trailing 12 months figures, we can begin here with the blue line or blue bars, which is basically the cash from operations. So we can see it's been pretty stable across the time here, and actually has been increasing as of late, which is good from management here, that they've improved the cash from operations, which I like to see, of course, and I think many investors do agree. The investing side of the business has been heavy all the time here, we can see. We can also see that it also accelerated here in Q1 2023, and it's been pretty heavy here until the end of 2023 Q4, where we can see a trend where the investing side has been reduced a little bit here. And we can also see the free cash flows here. As we remember from the previous slides here, we can also see that the margins here supports this with a positive cash flow here in millions here. Now on this page, we'll check the net debt in the blue bar and comparing it to the cash from operations in the orange bar here. And we can see that the net debt has been increasing almost every quarter for the trailing 12 months, which is obviously not a good sign, I would say. But then again, knowing this type of business, or not knowing it completely, but knowing that this is a Swedish serial acquirer, that means that they're continuously acquiring new businesses. So my assumption is that the net debt will go up. The only question here is whether or not they can support it with, growing their operational cash flows. So this is the type of situation as an investor that you don't like. You don't like to see that the gap of net debt to cash from operations widening, basically becoming a larger gap, because that means it's just going to take longer time for the company to pay off its debt with operational cash flows. And we've seen that trade here, as we see here, it's massively increased here. It will take several years here to pay it back, like six years or something like this, with just the operational cash flows for this situation. However, we've seen here that it's been reduced, and this is what I like to see, and I think a lot of investors do agree that once the gap is being reduced, it looks a little bit more healthier here. We can see that cash from operations has been increasing quarter over quarter, and we can also see here that the net debt has been stabilized, and it's definitely lower here at this side here, 2.6 billion compared to the 2.9 billion. So it has been reduced here, but I'm not sure if we're going to go back to a period where maybe the operational cash flow will be more in line with the net debt or not. But at least this is how the situation looks like. And as for this situation, it will take roughly 2 years with just the cash from operations to pay off the net debt. So it's not a bad situation right now, as it looks like, just comparing these two numbers at least. Now for the net debt to EBITDA, it currently sits at 1.6 times, and it's been sitting at that number for, I would say the past few years, it looks like, or past few quarters, sorry. And this is also the trailing 12 months numbers here, figures. We can see here that the figure has been higher historically speaking, so 2.3 times here, but there has been some periods where it's gone back to 1.6. So I would say that the net debt to EBITDA looks pretty okay. It's not negative, which obviously would have been better, but it's not, it's not 3.5 or 4 times or something like this, which would be alarming. So it's definitely an okay number. And comparing it to some peers here, we have Indutrade that sits at a multiple of 1.7 times, and Adtech at 1.5 times net debt to EBITDA. So even the peers are sitting at a similar situation as Lagercrantz is doing right now. Now for the CEO remark, and we can see that they have improved their margins. So for example, the operating margin here increased from 17.8% up from 16.5%. So that's a 1.3 percentage point increase, which is good. He's also saying here that the cash flow from operations were strong for the first half year. So we can see a doubling of the cash from operations, which is good in this environment. It never hurts to have improved cash flows, in my opinion, especially not now with the inflation happening in the world. We can also see that he's continuing to increase his results despite of the cyclical environment that we're in right now. And he also highlights here that they have a strength in their vision and business and business culture and organization. And yeah, he'll basically says that they're continue to grow through profitable and well-handled acquisitions and companies within technical and expensive niches. Continuing here with the CEO remark, I think the most important thing in this letter is that they reached some financial target here of 1 billion Swedish kroners here during summer, and that was 3 years ahead of their plan. So this company, I mean, they've been growing quite fast, as you probably can imagine, if they reach their target 5 years ahead of plan. And I think it looks like they have a 5-year cycle where they do this planning. So now it aims to double this 1 billion to 2 billion here, as we can see, in the next 5 years. His ambition is also to increase the acquisition tact to 8 to 12 acquisitions a year compared to the old target of 5 to 8. And he's creating some division here that should allow this to be a possibility. He also says here that despite of all things happening in the world with wars and everything, I guess he's meaning here, he's still quite optimistic about the cyclical environment. So I think this speaks volumes. It just seems that he's very optimistic about his business and the company going forward. So obviously this guy is quite bullish, but as I mentioned previously, they still have some debt levels and so on, so it's not risk free, but it seems that this company is it's going pretty well, at least for this company right now. Thank you very much for watching this video of Lagercrantz Group in the most recent quarter. If you liked the video, please hit the like button below and subscribe for more content going forwards. All right, thank you. Bye bye.